Today is Tuesday, 27th of May, 2025 Eastern Time. This news is brought to you by Preeti Capital, your trusted source for financial insights. The financial markets exhibited a nuanced performance as trading commenced this week, with technology stocks spearheading gains across major indices. This sector's ascent was bolstered by renewed investor confidence in its growth potential, likely influenced by recent advancements in artificial intelligence and digital infrastructure. However, the optimism was tempered by a backdrop of global uncertainties that continue to loom large over the financial landscape. Despite the technology sector's robust performance, the broader market sentiment was characterized by caution. Investors remained vigilant, closely monitoring geopolitical developments that could influence future economic stability. This cautious optimism was reflected in the mixed movements of key indices, which, while generally trending upward, displayed varying degrees of volatility throughout the trading day. Commodities and currencies also reacted to these geopolitical cues, illustrating the interconnectedness of today's global financial ecosystem. Oil prices, for instance, experienced fluctuations as traders gauged the potential impact of ongoing diplomatic negotiations in the Middle East. Meanwhile, gold prices held steady, serving as a traditional safe haven amid the prevailing uncertainties. Currency markets reflected similar dynamics, with the US dollar displaying resilience against a basket of major currencies. This strength was underpinned by expectations of a robust domestic economic outlook, though tempered by concerns over potential interest rate adjustments by the Federal Reserve in response to inflationary pressures. In summary, today's financial market activity underscored the delicate balance investors are navigating between optimism in certain growth sectors and the broader global challenges that persist. As the week progresses, market participants will likely continue to weigh these factors, seeking to align their strategies with the evolving economic landscape. In recent market activity, global indices exhibited a mixed performance, with notable declines in major U.S. benchmarks. The S&P 500, a key indicator of U.S. market health, fell by 0.67%, suggesting a broad-based pullback across sectors. The Nasdaq Composite, heavily weighted towards technology stocks, experienced a sharper decline of 1.00%, reflecting potential investor concerns over tech valuations or economic data impacting growth expectations. The Dow Jones Industrial Average also saw a decrease, albeit less pronounced at 0.61%. This decline indicates a cautious sentiment among investors, potentially driven by macroeconomic factors or corporate earnings reports that failed to meet market expectations. Contrasting the U.S. market, the Volatility Index, VIX, saw a significant drop of 7.72%, suggesting that despite the declines, there is a reduced market expectation of volatility in the near term. This could indicate investor confidence in the market's ability to stabilize or recover in the short run. In Europe, the FTSE 100 modestly declined by 0.24%, while Germany's DAX surged by 1.68%. The rise in the DAX could be attributed to positive economic data or corporate performances that exceeded expectations, thereby boosting investor confidence in the German market. Asian markets also experienced declines, with Japan's Nikkei 225 and Hong Kong's Hang Seng Index decreasing by 0.24% and 0.16% respectively. These movements might reflect regional economic challenges or global economic uncertainties impacting investor sentiment. Similarly, the Shanghai Composite Index fell by 0.24%, possibly indicating concerns over China's economic growth or regulatory developments affecting market dynamics. Overall, the mixed performance across global indices underscores the complexity of current market conditions, where regional factors and sector-specific dynamics play significant roles in shaping investor behavior and market outcomes. The current landscape of bond yields reflects a relatively stable environment, with key benchmarks showing no movement today. The 10-year Treasury yield stands at 4,509%, a crucial indicator as it often influences various interest rates across the financial system, including mortgages and loans. Investors closely monitor this yield as it provides insights into market sentiment regarding economic growth and inflation expectations. The 3-month Treasury bill yield is at 4.23%. This short-term government debt instrument is a favorite for investors seeking liquidity and safety. Its yield is also a bellwether for short-term interest rate expectations and can be influenced by Federal Reserve policy decisions. A stable yield at this level suggests that the market anticipates no immediate changes in the Federal Reserve's current monetary policy stance. On the long end of the curve, the 30-year Treasury bond yield is reported at 5.031%. This yield typically reflects long-term expectations about inflation and economic growth. With the yield holding steady, it indicates that investors are currently not expecting significant changes in the macroeconomic outlook or inflationary pressures over the longer term. The lack of movement across these key yields suggests a period of market equilibrium, where investors are digesting current economic data and Federal Reserve signals. It could also point to a wait-and-see approach as market participants anticipate upcoming data releases or policy announcements that may impact future yield movements. Stability in bond yields can provide a level of predictability for both individual and institutional investors, allowing for clearer financial planning and risk management strategies. Overall, the current yield environment underscores the importance of monitoring broader economic indicators and central bank communications, which can significantly influence market dynamics and investor strategies in the bond market.